Hi, this is Dr. N. Gangisetty, Professor, School of Management, MITS deemed to be University, Madanapalle, Andhra Pradesh, India. Today, I am going to explain about working capital. So, the people every day they are going to discuss about that capital or working capital or money. So, we don't have any working capital like that. So, that here it is better to understand what is the working capital, why it is necessary, what is the reasons for maintaining more and less working capital by different types of the companies. Let us discuss one by one. So, here, first of all, what is capital? What is capital? So, capital is nothing but resources or money or assets. At the time of starting any business, we require money or resources or assets to start a business. So that whatever we are going to bring into the business to start the business, whatever the form like money, resources, or assets, all together we are calling it as capital. In simple, capital is nothing but the initial amount which we are going to introduce into the business is called capital. Now, this capital is classified or divided into two broad categories. One is fixed capital and another one is working capital. What is the fixed capital? What is the working capital means here? Fixed capital means here the capital which is used to procure the facilities for creating or producing the goods and services. Once again, fixed capital is the capital which we require to create facilities for production of the goods and services. That means here we want to purchase the land, we want to construct the buildings, we want to install the machineries. In addition to that, we want to procure so many things in the organization to start the production activities or service related activities. For all these things here, we need to establish one organization. So for that we require money. Whatever that the amount spent for this one is called fixed capital. At the same time, after establishment of the organization or creating facilities for the production of goods and services, we want to run the business. Run the business means here we want to purchase the raw material, we want to engage the labor force, we want to meet day-to-day expenses for conversion of raw material into finished goods or at the time of selling, at the time of doing different types of activities in the organization. We want to bear different types of petty expenses. For all these expenses, we need money. That is called working capital. So, working capital needed for day-to-day expenses like purchase of raw material, payment of wages, or payment of day-to-day expenses and other things. Now, let us consider the meaning of working capital. Of course, working capital is defined as the excess of current assets over current liabilities and provisions. This is the general statement. Of course, but as per the accounting terminology, it is the difference between the inflow and outflow of the funds. Inflow and outflow of the fund. That means here how much the funds are coming inside, how much the funds are going outside. So that inflow and outflow of the funds. So working capital includes stock of materials, semi-finished goods, including work in progress and finished goods and byproducts, cash in hand at the same time, cash at bank also. Now, let us consider some of the important definitions given by some of the important personalities in the area of accounting or finance related subjects. The first one is Mead, Baker, and Malott. According to Mead, Baker, and Malott, working capital means current assets. That means whatever that current assets maintained by organization collectively calling as working capital by Mead, Baker, and Malott. And next is JS Mill. According to JS Mill, the sum of the current asset is the working capital of a business. The sum of, that means the total of current assets is the sum of working capital. That means whatever that here the current assets maintained by the organization, we want to call it as working capital. And another one is Western and Brigham. According to them, working capital refers to a firm's investment in the short-term asset. Working capital refers to a firm's short-term investment. That means cash, short-term securities, accounts receivables, and inventories, whatever any other short-term assets which we can convert into cash within 1 year. Working capital is the amount of funds necessary to cover the cost of operating the enterprise. See that? To cover the cost of operating enterprise. To cover the operating enterprise means here we want to run the organization. If you want to run the organization, we need to bear the day-to-day expenses. We have to pay the day-to-day expenses, including raw material, wages, or any other expenses in the process of conversion of raw materials into finished goods, as well as the operating expenses at organization level, production level, marketing level, whatever that here. So that according to Shobit, working capital is the amount of fund necessary to cover the cost of operating the enterprise. And one more is according to Jinstenberg, circulating capital. So this person is calling working capital as a circulating capital because it is going to circulate in the organization. So fluctuations will be there because of inflow and outflow. So that is calling circulating capital. So circulating capital means current assets of a company that are changed in the ordinary course of business from one form to another. For example, cash to inventories, inventories to receivables, receivable to cash. So current assets are constant or common, but one form to another form. For example, here, if you buy the raw material, definitely we want to give the cash. Cash is going outside. Proportionately, for the same worth, we are going to get the raw material. So the value of the raw material is going to increase and the value of cash is going to decrease. The total current assets will be the same. So that here, change in the ordinary course of business from one form to another form, that is called circulating capital or working capital according to Jenstenberg. Now, working capital is classified into two broad categories. One is gross working capital, second one is net working capital. Why gross working capital? Why net working capital means here? According to the definitions which we have discussed prior to this particular slide here, some people argued that, or some people concluded that here total current assets are nothing but working capital. Some other people inflow and outflow, the difference between inflow and outflow, likewise they have classified. So that here the gross working capital is the capital invested in the total current assets of the business concern. That is, gross working capital is nothing but current assets. The total current assets are nothing but gross working capital. And another category, that is net working capital. Net working capital is the excess of current assets over the current liability of the concern during a particular period. See that once again, net working capital is the excess of current assets. Excess of current, that means here the organizations have to maintain the more current assets with compared to the current liabilities. So excess of the current assets over the current liability of the concern during a particular period. That is, net working capital is equal current assets minus current liabilities. So where current assets will be more with compared to the current liabilities. So let us see that what are the components of the working capital. So till now we have discussed that current assets, current liabilities. Current assets means what are the current assets? What are the components of the current assets? So basically cash. Cash is highly liquid, so that it is a main part of the current assets. After that, bank balance, bills receivable, sundry debtors, short-term loans and advances, inventories, prepaid expenses, accrued income. In case of any other item identified as a short-term asset, that is also included in the list of the current assets. And the contrary to these current assets here, what are the current liabilities? Like short-term payments or short-term obligations, like which includes bills payable, sundry creditors, outstanding expenses, short-term loans and advances, which we want to clear within a short period, not more than 1 year, within 1 year or 6 months like that. Dividend payable, that is outstanding dividend, and bank overdraft, which we want to clear within a short period. Provisions for the tax. So these are the current liabilities. Once again, positive working capital and negative working capital. There are two more categories are there. What is the positive working capital? In the previous slide, we have discussed that here working capital is nothing but current assets minus current liabilities, excess of the current assets over current liabilities. In case where the excess of the current assets over current liabilities happens, that is called positive. Positive. Sometimes the current liabilities will be high with compared to the current assets. That is, excess of the current liabilities over current assets is called negative working capital. So, by using the formula, working capital is equal to current assets minus current liabilities. The working capital is positive, that is positive working capital. In case where the working capital is negative figure, that is called negative working capital. Now, what are the objectives of working capital management? Working capital management. Why we want to give priority to that working capital? Why the organization they have to maintain adequate proper working capital time to time? So working capital management aims to ensure that a firm efficiently manages its short-term assets and liabilities to maintain smooth operations and financial stability. So let us see the first objective of working capital management is maintain adequate liquidity. The most important thing is if anybody wants to run their organization, they should possess minimum required funds with them by maintaining the proper liquidity. So ensure the firm has enough cash to meet their day-to-day expenses without fail, because the name and fame goodwill of the organization depends upon how they are meeting the day-to-day expenses, and helps in paying the wages, suppliers and other short-term obligations on time without further delay, without neglecting, without asking them to come again like that. So maintain the adequate liquidity is the primary objective of working capital management, and ensure the profitability. Avoid excessive investment in the current assets. Current assets. So there is a rule for that current assets. That is a standard for the current assets. Current asset ratio is 2:1. For every current liability of 1 rupee, we want to maintain 2 rupees. If anybody maintains more than that here, that leads to minimizing the profitability on the part of the organization. So that avoid excessive investment in the current assets. Strike a balance to that funds generate maximum returns. So instead of keeping funds ideal in the current assets, that is in the working capital, if they transfer to some other, that fetches some income, that gives some more returns. So that is one. That is ensure profitability. Optimum utilization of the resources. Optimum utilization of the resources means here use current assets efficiently, effectively without keeping idle funds. Prevent wastage of the financial resources. That means optimum utilization means here how much we require. Accordingly, we want to maintain the funds in the current assets. Keeping funds more in the current assets leads to non-productivity, and automatically that minimizes the production as well as profitability. Now, balance between risk and returns. Where there is a high risk, we'll get high return. Low risk, low return. Opposite to this one, high liquidity reduces the risk, but it minimizes the profits. High liquidity reduces the risk because if you maintain the funds more and more, there will be low risk. But what is the use of maintaining that much of funds here without transferring the same for the productive areas? That is one. Low liquidity increase the profitability because we are going to invest the funds in somewhere without maintaining proper working capital. that gives more profit, but there is a high risk which leads to entering into the risk. And smooth flow of the operations. So where we are going to maintain the proper adequate amount of working capital, ensure uninterrupted production and business activities that avoids shortage of raw materials or cash, that ensure smooth running of the business. That is a smooth flow of the operations. Maintain solvency. So ability to meet the short-term liabilities and maintain financial stability, and that protects the business from the insolvency risk. Generally, the creators, who at the time of supplying the raw material, and some other people who are dealing with that, the organization, they are going to consider how they are paying the money. In case where the company not in a position to meet the day-to-day expenses, not in a position to pay the day-to-day expenses, how they can pay other expenses? The people are going to get some confusion or may suspect the organization. So that here, maintain the solvency. Improve the credit worthiness. When the company meets the day-to-day expenses in time, for example, the creditors, credit payment period is 2 months. If the company meets the period, pays within the 2 months or on time, then the creators again and again they are going to supply. They are ready to supply. They are ready to extend their credit worthiness also. Banks also, when the company uh, gets overdraft facility or the suppliers are more are there, different types of the suppliers are ready to supply whenever we request to supply the raw material. So that here proper management of build trust with the creditors, banks, suppliers, so that improves the credit worthiness. Some companies maintains the credit worthiness, so that here the company deals properly with all the people by maintaining the proper liquidity. So that also helps in obtaining loans very easily from any other person, because at the time of getting the loans, the banks and other people, they are going to consider how they are going to meet the obligations of the creditors, in simple outsiders. Efficient inventory management. So when the company maintains the liquidity, so that they are going to maintain optimum stock level, optimum stock level. Avoid overstocking and understocking, because they maintains by following that different types of the inventory management techniques like minimum level, maximum level, danger level, other things. Here they are going to avoid overstocking and understocking, and maintains the optimum stock levels which they require to produce. Depending upon, again, there are so many factors are there, like whatever that here availability of the raw material, cost of the raw material, or that is the price of the raw material. So transportation cost, inventory cost, ordering cost. There are so many factors are there which are going to influence maintaining the levels of the stock. So that based on that here, the organization efficient inventory management techniques follows and maintains properly. So proper management of the receivables, the most important. So what is the receivable policy of the organization? Ensure timely collection from the customers by giving the adequate time to the customers, recollecting the money or asking them to repay the money in time, and reduce the bad debts and improve the cash flow. To reduce the bad debts here, time to time, sometimes the organization provides cash discounts or any other offers also. So minimize cost of funds. Minimize cost of funds means here, by maintaining that working capital properly, they are going to minimize the cost of funds. In what way means here? Reduce the financing cost by using funds wisely. Financing cost. Avoid unnecessary borrowing. For that working capital purpose, no need to depend upon any other person if they maintain properly. So, what is the need of working capital basically in general? So, working capital is an essential part of the business concern. Remember, no doubt about that one. So, wherever working capital is the essential part of the business concern. Every business concern must maintain certain amount of working capital for their day-to-day requirement and to meet the short-term obligations. Generally, in general, what are the short-term obligations in any kind of organization means the first and the most important obligation is purchase of raw materials and spares. That is, for purchase of raw materials and spares here, we need to have sufficient funds with us. That is the first one. So that accordingly the firm has to maintain the working capital. So after procuring that raw materials and other things here, in the conversion of raw material into finished goods, we want to engage the labor force. So that here payment of wages and salaries for the administrative people. That is the most important. So payment of wages and salary is another one. In addition to that, raw material and wages and salaries, the day-to-day expenses, whatever that here, ranging from transportation, insurance, or advertisement, or traveling expenses, or like conveyance expenses, whatever that in the organization, the day-to-day expenses which the organization people are going to meet regarding that salesman expenses or production department expenses or office expenses, all expenses should be maintained and paid out of this working capital and provide credit obligations. Sometimes the workers, that is, or the employees may request the management to provide some advance in case of the emergency. So that credit obligations also. Some people are going to take the advance based on their obligations. So that here provide credit obligations. So these are the four major obligations why one should maintain proper, adequate, sufficient working capital in the organization. Okay, thank you for watching my videos. If you have any doubt here, you have to write, feel free. I will explain. Thank you. Thank you, Anandal.